Black Swan. Underestimation. The COVID-19 pandemic was first officially reported in Wuhan, China, on December 31, 2019. Initially, through mid-January 2020, Wall Street largely overlooked the outbreak, maintaining a cautiously optimistic stance about its potential impact on the global economy. This period was characterized by a general underestimation of the virus's potential to disrupt economic activities worldwide. As January 2020 progressed and the virus began to spread, the number of new confirmed cases in China started to increase exponentially, extending rapidly to other major cities within the country. Wall Street began to partially acknowledge the gravity of the situation by the end of January, culminating in a significant 2% drop in the Dow Jones Index on January 31. However, this initial concern was fleeting, and optimism swiftly returned, leading to a recovery in the Dow Jones Index within just a few trading days. By February 12, the Dow Jones Index closed at a historic high of 29,551 points, and by February 19, the S&P 500 index peaked at 3,386 points. This optimism was largely fueled by reports suggesting a potential subsidence of COVID-19 in China, especially around February 10 when the daily increase in cases reported by the Chinese government seemed to be stabilizing. However, around February 20, 2020, the situation escalated with rapid increases in confirmed COVID-19 cases in key international economic hubs like Korea, Italy, and Iran. This sudden spike contradicted the initial forecasts that had anticipated the virus being contained within China. The situation became more alarming when, on February 25, the U.S. Centers for Disease Control and Prevention, CDC, issued a warning about the potential spread of the virus within the United States. The realization that COVID-19 could result in a global pandemic began to set in, prompting a significant shift in the economic outlook from a localized issue to a widespread global crisis. In response to these developments, the New York stock market, which had been nearing historic highs, began to plummet. The Dow Jones Index, which had reached a high of 29,551 on February 12, fell by 3.56% on February 24. Similarly, the S&P 500 and Nasdaq indices experienced significant drops. This marked the beginning of a more pronounced deterioration in the financial markets due to COVID-19, with February 24 being pinpointed as the initial signal of the crisis. As the reality of the economic threat became apparent, investors shifted their strategies from high risk, high return to low risk, low return, moving their investments from riskier assets like stocks, junk bonds, and real estate to safer havens like U.S. Treasury bonds, U.S. dollars, and gold, aiming to preserve asset value and ensure liquidity amidst growing uncertainties. This transition marked a significant shift towards risk-off trading as the global economic landscape faced the unpredictability of the burgeoning pandemic. 1. Spread of stock market fear. As the stock market, a quintessential risky asset, began its steep descent, investor anxiety escalated dramatically. The Dow Jones Stock Index, which had reached its peak on February 13, experienced a precipitous drop of 20% by March 9. Similar significant declines were also observed in the S&P 500 and Nasdaq indices. This growing concern among investors was mirrored in various market indicators, particularly the Chicago Board Options Exchange's CBOE Volatility Index, VIX, often referred to as the Fear Index. The VIX is derived from option prices in the derivatives market and serves as a measure of expected market volatility over the ensuing 30 days. An upsurge in the VIX index signifies increased market uncertainty and heightened investor anxiety. From a relatively calm 13.74 on February 12, the VIX index rocketed to 40.11 by February 28, marking an 82% increase and indicating a surge in investor trepidation. The trajectory of the stock market is fundamentally influenced by expectations surrounding economic growth and interest rates. Normally, as growth expectations rise, so do stock prices. Conversely, as interest rates increase, stock prices tend to fall. The stock market downturn during this period was primarily attributed to a drastic faltering of growth expectations. While a looming economic recession might prompt the Federal Reserve to slash the benchmark interest rate, potentially leading to an influx of money into bonds, thereby elevating bond prices and reducing market interest rates, the pervasive gloomy economic outlook significantly dampened the potential impact of such expected interest rate cuts. The overwhelming sense of pessimism regarding the economy's future far outweighed any positive effects that might arise from lower interest rates, driving the market into a downturn and reflecting the pervasive anxiety among investors. Strength of government bonds. As the market sentiment shifted towards risk aversion amid the COVID-19 crisis, investors increasingly sought refuge in safe haven assets, leading to notable trends in the bond market. Specifically, the price of U.S. 10-year Treasury bonds, widely regarded as a prime example of a safe haven asset, began to rise. Correspondingly, the yield on these bonds, which moves inversely to price, started to decline. This phenomenon wasn't exclusive to the United States. Government bonds from other countries recognized for their stability and safety, such as Germany, Japan, and Switzerland, also experienced price increases during this tumultuous period. In the context of prolonged low interest rates, the shock of COVID-19 intensified the move towards safer assets, causing market interest rates to plummet further. The yield on the 10-year U.S. Treasury bond continued to shatter historical records, dropping from 1.61% on February 13 to an unprecedented low of 0.54% by March 9. This downward trend in yields reflects the rising prices of these bonds as investor demand surged. The increase in demand for government bonds, which pushed up their prices and thus lowered yields, was driven by investors' anticipation of imminent economic downturns and the expectation of a corresponding monetary policy response from central banks. In uncertain times, when a recession seems likely, investors often predict that central banks will adopt easing measures such as cutting target interest rates to invigorate the economy. Anticipating further declines in bond yields, investors tend to move quickly to purchase government bonds while the yields are relatively higher, thereby locking in better returns before potential rate cuts further diminish yields. This collective movement towards government bonds amid economic uncertainty is a classic example of risk-off behavior, highlighting the protective stance investors adopt to safeguard their portfolios during volatile periods. Widening spreads in the corporate bond market. On February 24, the New York stock market experienced a significant drop, marking the onset of the economic crisis induced by COVID-19. In this turmoil, corporations, which had accumulated substantial debt in an environment of prolonged low interest rates, found themselves particularly vulnerable. Despite this debt accumulation, many companies' profitability did not increase proportionately, leaving them exposed when the crisis hit. As the financial markets became stressed, the risk of corporate bankruptcy escalated, prompting investors to demand higher yields or additional interest rates on corporate loans to compensate for the increased risk. Investment-grade bonds are considered safer investments, issued by financially stable companies with lower credit risks, and thus yield lower returns. High-yield bonds, conversely, are issued by companies with lower credit ratings and carry a higher risk of default, thus offering higher yields to attract investors. An important metric in this market is the corporate bond credit spread, which measures the yield difference between various grades of corporate bonds and comparable government bonds. This spread serves as an indicator of the perceived risk associated with corporate bonds over government bonds. As economic conditions worsen or the financial health of a company deteriorates, this spread typically widens, reflecting increased investor apprehension. Due to the dynamics of credit spreads, even as the yield of Treasury bonds decreases, the yields of corporate bonds can increase. As market conditions or the financial stability of corporations become more uncertain, investors demand higher yields for taking on the increased risk of corporate bonds, causing their yields to rise even though Treasury bond yields are falling. Starting February 24, as the crisis unfolded, the spreads of both investment-grade and high-yield bonds over government bonds began to increase, with the spread for high-yield bonds widening more rapidly. This accelerated widening indicates that investors were significantly more concerned about the potential default of companies issuing high-yield bonds, demanding higher yields as compensation for the elevated risk. This shift in the corporate bond market reflects the broader impact of the COVID-19 crisis on corporate financial stability and investor sentiment. The exchange rate of a currency largely hinges on the country's interest rate levels and economic growth expectations. Typically, rising interest rates bolster a currency's value, and positive growth outlooks attract international investments, increasing demand for that currency. However, amidst a shift to safe assets like government bonds, which saw yields plummeting since mid-February due to risk-off sentiment and heightened economic uncertainties from COVID-19, the US dollar experienced a significant weakening. This was somewhat atypical as the dollar, often considered a safe haven, would usually strengthen in such scenarios. The dollar index, DXY, notably declined, reflecting this unusual trend. This weakening was particularly driven by a sharp decrease in U.S. government bond yields and relative strengthening of the euro and Japanese yen, both key components of the DXY. Carry trades unwinding, where investors borrowed in low-interest rate currencies like yen and euro to invest in higher-yielding assets elsewhere, led to strengthening of these currencies as funds flowed back. Conversely, the US dollar remained robust against currencies from emerging markets, where economies heavily reliant on raw material exports faced declining demand due to the anticipated global recession, leading to a dimmer economic outlook and currency weakening. Gold, a traditional safe haven asset, usually sees its price inversely correlated to the dollar's value. As the dollar weakens, gold typically rises in value. Gold's appeal lies in its long-standing status as a store of value and medium of exchange, coupled with its limited supply. As economic uncertainty grew with the spread of COVID-19, gold prices started to climb, peaking in response to escalating fears and the dollar's depreciation. This trend echoes past instances, such as post-2008 financial crisis, where extensive quantitative easing and near-zero interest rates led to a prolonged period of dollar weakening and a corresponding surge in gold prices. However, as the Federal Reserve began tapering and moving towards a tighter monetary policy, the dollar strengthened and gold prices declined. These dynamics underscore gold's status as a counterbalance to the dollar and its sensitivity to broader economic shifts. Oil war. In portfolio management, commodities like oil are often considered risky assets. Oil, in particular, garnered significant attention during the COVID-19 crisis for its volatility and pivotal role in global economics. Typically, in a risk-off environment, investments in commodities such as oil decrease, leading to a drop in their prices. However, the crude oil market was facing an even more severe situation during the pandemic. Going back to the mid-2010s, international crude oil prices had been steadily declining, largely due to a boom in shale oil production in the United States. The outbreak of COVID-19 exacerbated the situation as China, a major consumer of crude oil, implemented strict containment measures that drastically reduced its economic activity and, consequently, its oil consumption. Prior to the pandemic, global oil consumption was around 100 million barrels per day, with China consuming about 15%. The halt in China's economy significantly impacted the oil demand and contributed to falling oil prices worldwide. OPEC+, which includes OPEC members and allied non-member nations, had been discussing reducing oil production early in the year to prevent oversupply and stabilize prices. However, disagreements, particularly between Saudi Arabia and Russia, made it difficult to reach a consensus on production cuts. The stalemate escalated when Saudi Arabia proposed a substantial cut of 1.5 million barrels per day, which Russia refused. In retaliation, on March 8, Saudi Arabia announced an increase in production and significant price cuts, marking the start of an oil price war. This led to an abrupt fall in oil prices, with WTI crude plummeting by 27% on March 9. The undercurrent of this tension was Russia's belief that the production cuts were benefiting the U.S. shale industry. As OPEC Plus reduced supply to maintain prices, the U.S. shale producers, thriving under higher prices, were increasing their market share. Russia's refusal to cut production was partly aimed at weakening the U.S. shale industry, which needed oil prices to remain above $40 to $50 per barrel to be economically viable. The plummeting oil prices had a mixed impact on the U.S. economy. Lower oil prices acted as a subsidy by decreasing fuel costs for consumers but simultaneously threatened the shale industry, crucial to the U.S. economy. The shale sector had expanded significantly, supported by investments and low-interest borrowing. However, the drop in oil prices led to reduced profitability and increased financial stress, with many shale bonds being downgraded to below investment grade. This created a risk of widespread bankruptcies in the high-yield bond market and added to the deflationary pressures in the market amidst reduced demand and social distancing measures due to COVID-19.